This conversation is going to be focused on India, thinking about longer term and shorter term investment opportunities with Gautam Baid here. I've been doing a few of these spaces covering India because I think it's an interesting place to focus attention on. I think Gautam's got some good insights here. I will have this on all your favorite podcast platforms as well as available on YouTube under the Lead Lag Live banner. My name is Michael Gayed, publisher of the Lead Lag Report. Joining me for the hour is Gautam Baid, who's got a long history when it comes to investing in markets. Gautam, for those who are not familiar with your background, introduce yourself. Who are you? How'd you get interested in investing, and what are you doing today?
Sure. So, first of all, Michael, thank you for conducting all these Twitter spaces and your lead lag reports. I think they are a great value add to the investment community. So, thanks for that. So, coming to my background, I was born and brought up in India. And I started my career with Citigroup as an analyst after completing my MBA in finance. I worked with Citigroup as an analyst for 3 years. And then I worked with Deutsche Bank for 4 years at their India, London, and Hong Kong offices. Now, all throughout those first 7 years of my professional investment banking career, always had a very deep passion for the stock markets and the Indian stock markets in particular. And there is a reason for that. So I started, as is typically the journey of most investors. My journey in the stock market also began like most investors' journey does, which is typically near the fag end of a raging bull market. In my case, it was the 2003 to 2007 bull market in India. I still remember I'd invested in a mutual fund called Reliance Power Sector Mutual Fund and a stock named Ispat Steel in January 2008, because power and steel were the hot and fancied sectors of that bull market in India. Now, recency and vividness biases are very powerful but highly costly behavioral mistakes. I basically had extrapolated the recent price trends in those two investments without paying any heed to their valuations or underlying business models, and I paid the price for that. Both those investments crashed 70 to 80% within the first 12 to 18 months of my purchase, and I had successfully gained my entry into the stock market by paying my tuition fees. But in spite of that initial setback, my passion and interest about the stock market remained very high. And at the end of my 7th year in my investment banking career, one day I came to the realization that we just have this one short life to live our dreams. And I did not want to waste any further time doing something that I was not truly passionate about. I wanted to get on the buy side in the stock market as an analyst. So I relocated to the US in 2015. I was under the impression that since I'm a CFA charter holder as well, and this particular degree is highly valued in the investment industry, I will land a stock market job pretty easily. But life is not so smooth for those trying to carve their own destiny. So in the first 6 months of coming to the US, I gave 3 stock market jobs, could not convert them, had 1.5 years of struggle later on. But thankfully, by the end of 2016, I had landed a good job as a portfolio manager of global equity strategy with Summit Global Investments in Salt Lake City, Utah, where I worked for almost 4.5 years. Now, during the course of my stint at Summit Global and tracking global markets, India as a stock market very clearly stood out to me in terms of the number of high growth opportunities it offered. And so last year in July, I quit my job at Summit Global and I started work on obtaining all the relevant regulatory approvals and licenses to set up this Delaware-based fund in the US and to bring the big India opportunity to investors in America. So as of today, I'm the fund manager and the managing partner of this fund, Stellar Wealth Partners India Fund. It's an investment partnership modeled after the original Buffett partnership fee structure. And we are an independent boutique, partner-centric fund based in the US that invests in listed Indian equities with a long-term, fundamental, and value-oriented approach.
Okay, so this is gonna sound like a silly question, but I think it is important to normalize for the way people think about what we do in this industry from an investment perspective. What exactly is a portfolio manager? Explain what your role was as a portfolio manager prior to launching the fund. What were the kind of things that you'd be doing?
So the biggest difference between an analyst and a portfolio manager is that the sell-side analysts or the buy-side analyst focus on pitching individual stock ideas to the portfolio manager. Once you become a portfolio manager, then your role is much more broad-based. It is just not about stock picking. It is much more about two important things. Number one, portfolio construction. And number two, the allocation. So basically, when I talk about portfolio construction, one important thing which you realize with the course of time as an investor is that you don't want to be overly concentrated to one single sector. You don't want a single sector or a single company to blow up your fortunes in the future. You don't want to take that chance. You want to basically minimize tail risk. This is also one of the biggest learnings we got from Warren Buffett as well. If Buffett comes across high tail risk in any investment, he simply shuts it off. He doesn't even look at it. So the moment you become a portfolio manager, you also focus on downside risk at all times from a overall portfolio level. Now, because investing is a probabilistic activity, even after following a very sound process, some investments will go wrong. But the moment you become a portfolio manager, you start looking at everything from a portfolio perspective in terms of sectoral diversification, not being overly concentrated in one single sector, managing the weights correctly for the stocks that you're investing in. How do you decide the weight given to a particular stock in the portfolio? That in turn depends on, is the business cyclical or secular growth? Is there a predictability and longevity of growth in the business? Those businesses get higher weight in the portfolio. And once you become a portfolio manager, your first and foremost emphasis is on risk management, risk management, risk management. That is basically what I emphasize primarily on in my role as a fund manager in my India fund.
Okay, now you and I both know that we can endeavor to try to cut off tail risks, but you can never fully cut off tail risks, right?
Exactly.
So even the point about Warren Buffett, you know, people forget that Warren Buffett's been down twice 50% in his career, as knowledgeable as he is, right, in terms of Berkshire's performance. Let's talk about tail risk for a moment when it comes to international investing, right? So oftentimes people will equate a crash to a tail risk. They'll think about it from a US centric perspective. What are the kind of tail risks that you try to think about when it comes to investing in India versus somebody that's maybe investing in the US?
I think the biggest source of tail risk, honestly speaking, when you're investing in an emerging market is that of corporate governance. And because unless you have extensive on the ground experience in that country, investing in that country, you will be subject to a lot of fraud, scams, and bad corporate governance practices being followed by many companies. Many of these promoters and owners can also try to siphon off cash from the books, and as a minority shareholder, as a passive minority shareholder, you are basically left holding the bag. So this is a very specialized form of investing, and only those who have got a long history of investing in that particular market, only those guys should try to endeavor to invest in an emerging market. Unless you know the local dynamics and the history of companies inside out, it's a very big tail risk in investing in emerging markets like South Africa, Brazil, India, China. I mean, look at what happened in China. That's a good example. So the Communist Party, because of their common prosperity program, basically just they want to reduce the influence and the power of many of these capitalists and big tech businessmen. So they basically brought, all those technology stocks have just been crushed to the ground. And now recently JP Morgan came out with a report saying that China has become uninvestable. Now you can keep on bottom fishing in that kind of a market, but I would rather avoid that market completely, because I don't want my investors and my fortunes to be determined by the whims and fancies of a government in place, right? So I don't want to do that. And it's already, in fact, investors are already betting with their money, and their actions are demonstrated by the flows. So just to give you an example, China and Taiwan together constitute almost 50% of the emerging market index, and India is a small weight. Still, in the last 2 months, India alone has attracted 75% of aggregate emerging market equity inflows. Why is that happening? A 5-6%, 10% index weight country getting 75% of inflows in the entire emerging market basket. Why is that happening from investors around the world? Because people are now realizing that because of China-Taiwan geopolitical tensions, China and Taiwan, the big heavyweights in the emerging market index, are basically becoming uninvestable for many people. So there is no alternative within the emerging market baskets like India, which offers you a large population size of 1.4 billion people, 20% of the world population, along with the rule of law and democracy and free capital markets. So that is why global investors are getting so attracted to India as a destination.
No, and that makes a lot of sense, right? Because if you recall, over a decade ago, BRICS were all the rage, right? Brazil, Russia, India, China. Now you don't have Russia, obviously, and China's, to your point, got its own problems. So the money that wants to go into that side of the emerging market space really is relatively limited in terms of the larger emerging economies, right? So Brazil and obviously more India. Now you mentioned that you think about tail risk from the standpoint of corporate governance. Talk about that in terms of how corporate governance on average tends to work in India. And if you're managing a portfolio of India equities of these companies, how do you track that corporate governance from a distance?
It's a very important question, Michael, and I would like to take a few minutes to answer this question in detail. I'm able to navigate that corporate governance concerns through following a comprehensive corporate governance checklist for each investment. So I look for any frequent change in auditors, any qualifications raised by auditors. Is there any abnormal auditor fees? Does the company have a long list of unaudited foreign subsidiaries with it? Does the owner of the business have any political affiliations or criminal proceedings against him? Have there been any cases of debarment by the capital markets regulator against the company? What is the history of attrition or churn in the C suite or the management in the company? Is the key management personnel drawing excessive remuneration or blowing large sums of minority shareholder money on building lavish corporate offices? Is the company diluting its equity a lot? Is the promoter holding or the owner holding coming down? Is the promoter pledging his shares? Has the company shared wealth with minority shareholders in the past through dividends and share buybacks? Is the company taking loans from the owner at an above market interest rate? Because that may be bad practice. Is the related party transactions very significant in size? What are the current and ex employees saying about the company? You can get this information on websites like glassdoor.com, for example. What are the industry experts and reputed investors saying about the company? Also check whether the promoter is running a similar business as the listed entity in his privately held company, because that may lead to a conflict of interest. Also evaluate accounting quality. So here I would like to touch on two aspects. Number one, volatility and depreciation rate, because the depreciation policy can be modified by the management to manipulate earnings. And number two, check whether expenses are being written off against the reserves and surpluses on the balance sheet instead of being routed through the income statement, thus inflating profit. Check whether the revenue recognition policies are too aggressive or not. Is the business very working capital intensive? Check for how much of the reported net income is getting converted into cash flow from operations, because at the end of the day, what matters for any business is how much cash flow it's generating to fund its investing and financing activities. Also check for any abnormally high margins versus the peers in a commodity industry, because it's very unusual for a commodity company to be earning 30% margins while its peers are earning 10% margins. Check for any excessive write-offs of assets in the past. Check whether the company is capitalizing its operating expenses to smoothen out earnings. Check for trends in the debt to equity ratio, any cases of defaults on statutory payments in the past, any high contingent liabilities, and finally, any off balance sheet obligations. For example, has the company guaranteed the debt of its group companies through the listed entity? Now, some people may ask, what does the need to do so much hard work? Who looks at balance sheet and cash flow during a bull market, let alone the footnotes to the accounts? And my response to them always is that then when you're in a position of fiduciary responsibility of managing other people's heart and savings, then you owe it to them to reciprocate their trust in you. And following this comprehensive corporate governance checklist has helped me avoid many landmines from the Indian stock market over the last decade and from my fund as well. So I think there is no alternative to hard work in this business. You have to put in the hard work and the effort.
Does the quality of that data differ based on the industries that you're focusing on within India? Because there's either more or less transparency. I think this is important because one of the things that people I think naturally get nervous about is the sort of regulatory standards being different when you think about international investing versus US. You don't know necessarily, unless you're actually there or know the culture or know the country, if that data that's being analyzed is valid or not.
Right. No, the reporting standards are pretty standard across most companies in India. So they are broadly comparable. That's not a problem. And anyways, a promoter or a company cannot fudge income taxes and dividends, right? Dividends and taxes are paid out of real cash flow. So that cannot be fudged by any company. I think that's again one more good quality filter, whether the company is paying a decent dividend as well as paying taxes in full. Those are some of the broad hygiene checks which you do for every company when you're analyzing stocks in India.
Okay, now you set up your, and this is kind of interesting to me. I wasn't aware of this until I saw your pin tweet and you sent me a DM about this. You set up your fund to have this interesting structure, and you referenced Buffett. Talk through the audience exactly what it is that you structured your fund around in terms of that comparison to Buffett. Why is it unique? How does it work?
So I was highly inspired by the original Warren Buffett partnership of the 1950s and 60s. And you will rarely find such an equitable fee structure in the investment management industry today as the original Buffett partnership. So Buffett used to charge 0% management fee and a 6% cumulative hurdle rate with a high watermark provision and a 25% performance fee on gains over 6%. Now, the reason why this structure is so unique is that when you're basically setting up a fund, you want to look for an uncrowded investment space, and by far one of the most uncrowded investment spaces in this industry is that of zero management fees. Just sample the statistic. In 2018, of all the registered, all the hedge funds which were registered with the SEC with assets over 100 million and below 100 million, only 14 of them charge zero management fees. And as a hedge fund manager, if you're charging zero management fee, it's a very strong signal that you're prioritizing delivering the best returns for your clients over gathering AUM, because you're not getting paid on AUM. You're getting paid purely on outperformance. You've set a high hurdle rate of 6%, and you get paid only when your returns exceed that particular hurdle. So it allows for a true partnership where you really are on the same side as your clients. In fact, last year I wrote to Buffett with the details of my proposed fund structure, and he wrote back to me last year in a letter saying that the entire structure which I've described is eminently fair. And once I got the blessings of Buffett, then I was basically good to go. I was like, okay, now I'm the right path, and this is what I want to do for the rest of my life. And I started work on setting up this fund. So we are a Delaware-based investment fund, and we invest directly into India. And this fund is available only for accredited investors in the US.
That must have been pretty exciting, right, to get that letter from Buffett directly.
It was. In fact, this was the second time I've received a letter from him. Previously, I received a letter from him for my book, The Joys of Compounding, when I sent him the manuscript to take his formal approval and permission to take the copyrighted content from his Berkshire Hathaway shareholder letters. So this was the second letter in my life which I received from him.
All right. So now you've done the portfolio management side of your prior job. Now you're managing your own hedge fund. Any similarities or differences in the way that you approach the management side and the client communication side, right? Because you said it yourself, right? You're trying to be a long-term in your investment view. And the challenge, as you know, when you're managing other people's money, and I know this myself as well, is that your time frame is going to be very different than your underlying investors.
Right. It is going to be very different. But one very good thing which I've done in this fund is that I think what helps my clients sleep peacefully at night is that they know that even I have invested a significant portion of my personal liquid net worth into this fund just to have skin in the game and to align my fortunes and outcomes with that of my investors. So I simply when I meet investors and talk with them, I simply tell them I'm treating this fund as a personal investment vehicle for compounding my net worth and my personal wealth. And if you want to participate with me in the journey in the world's fastest growing large major economy, most welcome. And if you do not want to join me for the ride, then I completely understand. It's not everyone's cup of tea. But I believe India's time has now come. I have no doubt about it now. So that's what gave me the conviction to actually put in a decent sum of my own capital into this fund in the very beginning.
Okay, so let's talk about some of those positive dynamics of India for a moment here. What is it that is particularly powerful in terms of the longer term momentum growth that you're seeing, that you're advocating just on a top down level?
So this is going to be pretty extensive and detailed. So let me just give a broad overview here. First of all, India is on a structural growth path for the last many years, but now it is at a very big inflection point. It took India 60 years almost to reach its first $1 trillion of GDP, but it took India just 7 years to reach the second $1 trillion. And the subsequent trillions are expected to be reached in faster succession, basically. Now, if we simply assume the market cap to GDP to approximate 1 over time, one can just envisage the kind of wealth creation that lies in store for investors in the great Indian businesses over the coming decades. Trillions of dollars. And who will capture the bulk of this upcoming wealth creation boom in the Indian stock market? The nation's best managed businesses and management teams with proven execution track record and the ability to scale up their operations. And this phenomena is known as the power law. I'll share a very incredible statistic here. So from between 1926 to 2016, in those 90 years, in the US stock markets, only 4% of the listed equities in this country accounted for 100% of the wealth creation. This was demonstrated by Professor Baid from the University of Arizona in his white paper. And a similar phenomena will play out in India as well over the next few decades. Just a handful of companies will capture the bulk of this upcoming wealth creation boom. So that's the first point about the market cap addition. Now, what India offers to global investors today is linear growth in GDP, but exponential opportunities within certain investment categories. What happens is, if you look at any good investor is an ardent student of stock market history. And if you look at the history of three major economies, US, Japan, and China, when those economies' GDP doubled from 2.5 trillion to 5 trillion, their stock markets did not just double. Their stock markets tripled or even quadrupled. And why did it happen? Why is it so that any nation's the fastest pace of wealth creation in any country's stock market takes place when that country transitions from 2.5 trillion GDP to 5 trillion? Why does this happen? It is because when you transition from a low income per capita country to a middle income per capita country, the basic spending on items like food does not go up much, but the spending on the categories of branded discretionary consumption and financialization of savings, these two categories simply explode. This is where India stands today. Today, India is at $3.3 trillion of GDP. And if we just go back 3 years in time to understand what happened as India was going from 2.5 trillion to 3.3 trillion, I'll give you some numbers, really mind boggling numbers here. So, 3 years ago, the total number of demat accounts or brokerage accounts in India was 35 million in total. Today, in just 3 years' time, that number has exploded to 105 million in just 3 years. So already that category which I was talking about, financialization of savings, that is already playing out in India as the journey has started from 2.5 trillion to 5 trillion. Number two, branded discretionary consumption. You look at the kind of wealth creation that is taking place in the stocks of wedding retail players, branded footwear retailers, other branded premium apparel companies in India. I mean, already basically India is becoming more aspirational. And if in a country of 1.4 billion people, you can offer a product which is aspirational yet affordable, you have got a potential of a multi-bagger in place because the runway for growth is so high. So that's the second point. Third, what are the two primary drivers of GDP growth, long-term GDP growth in any country? It is estimated change in the working age population and productivity growth. And over the next, as per a recent study published by Collaborative Fund Research, over the next 30 years up to 2050, apart from the US, which will keep benefiting from favorable immigration trends, India is the only large major economy in the world which will have a positive change in its working age population. But if you look at what's going to happen to large countries like South Korea, Spain, Germany, China, Russia, and Italy over the next 30 years, they'll experience the same problems which Japan has been facing for the last 30 years, that of an aging population. So here again, India has got a big edge. And finally, and the big macro picture in terms of business fundamentals. So over the last 7 years, the Indian banking system balance sheets have been cleaned up through a series of tough economic reforms. And we know from history that the big driver of GDP growth of any country is banking system credit flow. Also, during the last 7 years, corporate India and most of the companies in India have basically delevered and reduced the debt on their balance sheets. And now they're about to embark on a fresh capital expenditure cycle, a fresh capex cycle. So that'll lend. So, and we again know from history that for any broad-based bull market, you do need a capex cycle revival. So you'll have banking system credit growth plus a capex revival from corporate India. That will lead to boost in the return ratios of the companies there, and you'll get valuation re-rating, and subsequently you'll get a big boost in the corporate profit to GDP ratio. So this is the big macro picture why India is so exciting as a destination today.
Talk about how infrastructure looks currently in India, because presumably, I mean, here, at least in the West, I think a lot of people have the impression, which is, I don't think invalid, that there's a lot of infrastructure that needs to be built out in India. And India is obviously a very big country. How is that infrastructure build taking place, and how does that factor into higher commodity prices, which we could be in for a while?
So India is more than a manufacturing economy. India is more services led. So frankly, India is not that big a contributor to global inflation like China is. And as far as infrastructure and other aspects are concerned, I think there's a lot of scope for improvement, but we are on the right path. And India is a story of very slow and steady improvement and gradualism. So basically, India grows slowly in many aspects, but as an investor, anyways, I don't focus on infrastructure, road developers, and other asset-heavy industries because I'm more focused on free cash flow. So I basically try to look at most things from an investment lens, and anyways, infrastructure and regulated industries are outside my purview. I try to avoid government-facing industries to the maximum extent possible because if you invest in a project-based businesses, which is dependent on government tenders, there are big problems of cash flow because those businesses face a very elongated working capital cycle. So I just avoid. I think the way I deal with difficult problems in a country like India is to avoid them altogether as an investor.
Yeah, no, I think that's an interesting point. Okay, so let's do a little bit of a deeper dive on. You mentioned the services side. Obviously, what are a lot of people I think naturally think about technology, but what are some of the sectors, industries that you're seeing a lot of undervaluation in as you're managing the fund?
I think in today's digital era, If any, if and especially in a country where there has been a long bull market for many years, extra diligence is required to understand that things are usually cheap for a valid reason. So you will only get deep undervaluation and cheap stocks when there is an element of forced selling. So when does forced selling takes place? I think one of the best opportunities in terms of forced selling comes through spin-offs and demergers, because when a company is spun off from a large market cap parent and lists as a small cap stock, then you get a lot of forced selling from institutional shareholders who receive shares of the spun off entity and cannot hold on to this particular stock in their portfolio. So in the first few weeks of trading, you will see that newly listed small cap stock, which has been spun off from the end company, just falling 30-40% in this very short time. And that is when you can basically enter at a very cheap valuation and make good alpha for your investors. So as a disclaimer, just 2 days ago, I invested in a similar demerger spun off opportunity in India called Piramal Pharmaceuticals for my fund, India fund. And what had happened was that Piramal Pharmaceuticals was demerged or spun off from its large cap parent Piramal Enterprises. Now, Piramal Enterprises, the parent company, was part of the MSCI index. But once this new small cap company, Piramal Pharma, got listed, that time the MSCI index had to engage in forced selling. And therefore, this particular stock fell very sharply, almost 25-30% in just a week's time, because this stock was going to be part of the MSCI small cap index. So the MSCI large cap index was selling this stock to include it into its small cap index. So you got forced selling in just a week, and you were able to buy this good business at a cheap valuation. So I think undervaluation and cheap stocks will be available only in cases of forced selling. Otherwise, in normal routine markets, you'll have to pay a fair price or an expensive price to get into any quality stock in India. In India, quality never comes cheap. You have to let go of the re-rating factor, and you have to be more content with the compounding returns. But the compounding returns themselves are very good because the runway for growth is so large. I mean, those companies, there's many good companies which can compound earnings at 20% plus for a long period of time. And I think most investors will happily settle for that kind of a return over a decade or more.
Let me reset the room for the remaining minutes here. Everybody, please make sure you follow Gautam, obviously. And if you are interested and accredited, feel free to reach out to him directly. Again, I'll have this as an edited podcast on the Lead Lag Live banner on all your favorite platforms. And if you want to come up and ask questions, click on that bottom left mic request button. Okay, so I'm going to ask maybe again another obvious question, but I think an important one. So you're doing it in a hedge fund format. Obviously, there are a lot of ETFs one can access if they just want to get broad exposure to India. Talk about passive investing when it comes to India versus active. Here in the States, obviously, as you know, it's admittedly quite hard to outperform passive, very well documented, unless you have to get the right asset class at the right time. But are there more active opportunities from a stock picking perspective with India because maybe there's less efficiency? Just talk through that for a bit.
Absolutely, that's a very good question. And in fact, India has always been a stock pickers market. But as we mature as an economy over the next 30 years, I think that's a natural shift for any mature economy to gradually shift towards passive as active stock picking becomes more difficult over time. But I think India as a market offers plenty of bottom-up stock opportunities. At an index level, the market will look very expensive, 16, 17 times P 1 year forward, compared to the emerging market average of 9 to 10. But instead of looking at as India's stock market, look at it as a market of stocks. Basically, just go bottom up and find individual opportunities, because see, very, very important aspect here, Michael, is that since the performance fee in the fund is based on returns in excess of 6% in dollar terms, one has to account for 4 to 5% annual rupee depreciation as well. So in India, generally the Indian currency depreciates by around 4-5% every year versus the US dollar. So unless you're confident of making more than 20-25% in local Indian currency terms, this structure will not really work out for an Indian investor. At the same time, if you look at the performance of the India ETFs over the last 10 years, when you adjust for the Indian currency depreciation, if you look at them in dollar terms, I think over the last 10 years, the returns are, I think, low single digits. So it has been a very poor performance in dollar terms. And that's why I think active management is going to play a big role when you're looking for a investment vehicle into India.
Let's go to some of the audience.
I think this decoupling theory was last thrown up in 2008 as well, that Indian markets have decoupled and emerging markets have also decoupled because the emerging markets were going up. But we all know how that ended. India cannot remain completely insulated from the global phenomena. In fact, after today's Federal Reserve meeting, in which Jerome Powell sounded even more hawkish than usual, I think there'll be some immediate pressure in the short term on global markets, including India. But I think what I've seen this year, I'll give you an example here. So the Indian small cap index, for example, is down. It is down 16% year to date this year. But individual stocks within the small cap and mid cap index have given great returns already this year. I think it's best to just focus on individual stock picking and just ignore all this index noise. And frankly, when you're this is the big, huge behavioral edge which you get when you operate from a very long term perspective. Just to give you a live example here. So I'm sure many people in the audience today would not know what happened 6.5 years ago in January 2016. This is just an example I want to ask you. Do you recall what happened in January 2016 in the Indian stock market, Sushil? That time, the Indian small cap index had fallen almost 30% in just 2 months. And what was the reason? Because that time, the oil prices globally were crashing. And this year, the Indian small cap index fell 30% because the oil prices were rising. So there'll always be something to worry about. And we always focus so much on the short term and take a myopic view that we forget that in the bigger picture, in the long term scheme of things, these things eventually all get forgotten. I have a habit of maintaining an investment journal in which I was going through my journal entries from the 2018 to 2020 bear market in India, in which the small cap index had fallen 60% from the peak. And in March 2020, it seemed as if the entire world is coming to an end, as reflected in my journal entries. But eventually, after that, we had the biggest bull market in many decades, right? So these things, I think cannot be really forecasted with any great deal of consistency. So I would rather just focus on bottom-up stock picking and just handle all these short-term ups and downs. As long as the eventual destination is great, I'm willing to live with that volatility.
By the way, real quick, just it's more than just sort of time frame. I also think people, because they tend to think in terms of short term, often are not even thinking about the short term correctly. So I shared at the top of the nest. I'll be talking about this in a little bit, but it's like, okay, so stocks sold off because Powell is so much more hawkish. Okay, if that's the case, why is it that when you look at interest rate probabilities, the probability of a 50 basis point increase actually increased versus 75 from just yesterday? There's narrative and then there's data, right? And the problem is, the more short term, and I know this myself, right? The more short term your outlook is, the more blinded you are to the data, which counters the emotional movement of the market at the moment in time.
Absolutely. I think this is where the big edge for the patient investor comes in. I think in today's world, an investor's edge is not knowing more than others about a specific stock or a business. It's more about the mindset, discipline, and the ability to take a long-term view about the intrinsic value of a business. I think that good old school of value investing, as it was supposed to be, has gotten lost in today's hyper frenetic world, basically. But I guess this is what gives us also an edge. The patience is the biggest edge for investors today. I agree completely with you that if you look at history, every 5 years, the Indian government goes to a national elections. And in the 1 year leading up to that election, the government tends to engage in very populist and socialist policies. And that's why I mentioned in the beginning of this Twitter space that I avoid all government-facing business-to-government B2G businesses for my fund. I think the way to make big money in India historically has been to focus on consumer-facing sectors, and possibly some B2B businesses, business-to-business companies, which have got a very strong entrenched competitive advantage. I think that is the way to go in India. I think you can make short-term paper profits through investing in government-facing businesses like infrastructure and telecom, but those gains do not last for long. So I think it's better to avoid B2G businesses altogether. Just minimize. India is not a market to take risk in, based on my experience. India is a market where you want to crush risk from as many angles as possible. You want to crush corporate governance risk, regulatory risk, government risk, promoter and management risk, balance sheet risk. You want to just crush risk from as many, and business model risk. You want to just crush risk from as many angles as you can, and then just wait for the management to deliver on its guidance and its long-term plans. So I think that's the only way to success in India, based on my experience at least. But yes, the Indian market, the headline index definitely is expensive. And even today, if you see year to date, the Indian markets are positive in local currency terms, while the NASDAQ and the US has basically got decimated. And I think it'll further accelerate the sell-off here after today's Fed meeting. I don't have the exact numbers off the top of my head, but my India fund is a multi-cap fund. So we have small cap, mid caps, and large caps. As I've written in my book as well, that rather than focusing on market cap, I think just focusing on the individual businesses is a much better way to go. Yes, so so India is right now benefiting in a very big way from a phenomena we call in India as China plus one and Europe plus one. So as companies globally work on diversifying their supply chains, India is becoming a very big beneficiary. So just to give you a very recent example, so Apple, one of the world's biggest companies, recently announced that they'll be manufacturing the iPhones in India, and this is a huge development in India because for a long time we were trying to convince Apple to manufacture their iPhones in the country, and finally India's got the Apple's go ahead, and now Apple will be getting its iPhones manufactured in India. So the regulatory environment in terms of labor laws, in terms of ease of doing business, everything is improving gradually. But yes, I do agree that we have got miles to go and a long way to go. And again, I think look at everything from an investing perspective. So I think the biggest scope for alpha and returns are in countries and places where there is inefficiencies. So as something inefficient goes from bad to less bad to good to very good to excellent, I think that journey is when you basically make the returns as an investor. So that is the reason where, because so many categories in India are very under penetrated and there is such a long runway for growth, because of 1.4 billion people who are still transitioning from low income to middle income, I think returns should be pretty good over the next many decades. But one has to put in the work and avoid all the dodgy and shady companies, because there are 6,000 listed companies in India, and in my view, barely 100 to 200 out of them are fit for long term investments. I think the rest of the 5,800 companies are not suitable for long term investing because they are in cyclical businesses or commodity businesses or just bad business models. So I think investing is a negative art. Knowing what not to do is far more important than knowing what to do. So that's how I approach this particular aspect. Very good question. So first of all, just to answer your first question, I personally believe, if you ask me, that the BJP and the Modi government, I think they'll win in a landslide again. It may sound a bit unusual today, but I think they'll again win in a landslide, just like they won in 2014 and 2019, for the simple reason that the opposition parties in India are in complete disarray. There is no credible opposition leader. And when you're voting in a national election, you're basically voting for the prime ministerial candidate. What PM Modi does is he makes this national elections presidential in nature. So it's all about the prime ministerial candidate. And since people do not have a viable alternative today in terms of a very strong opposition prime ministerial candidate, that's why I think BJP will most likely win in a landslide once again in 2024. This may well be PM Modi's last term as prime minister as well because of his age. But I think this will be his final term. That's my opinion about what I think will happen after 2 years in the election. And your second point was about the high unemployment among the youth. And to address this very issue, what the Indian government has come up last year is a game-changing reform called PLI, Production Linked Incentive Scheme. So what PLI does is it encourages companies in India to manufacture at a big scale and gives them a lot of incentives for doing so. And manufacturing is a very labor intensive by nature. So, this will help alleviate the unemployment concerns to some extent. So the Indian government is cautious and very conscious about this aspect, and that's why in the PLI scheme also, the most labor-intensive sectors like textile and auto ancillaries have been given the biggest amount of incentives. So I think the government is very cognizant of the problems and they are trying their best to address it. But again, we have to be realistic that in a country of 1.4 billion people, in which there's pretty high unemployment, unless we address this unemployment issue, this demographic dividend could turn out to be a demographic disaster and lead to a lot of social unrest as well. Hopefully, through the recent government actions, this problem will be curtailed to a large extent. So there are two things here. First of all, Adani's phenomenal rise has been primarily funded by huge amounts of debt. If you look at the total debt of the entire Adani group, it is reaching stratospheric proportions and quantum now. It's becoming very dangerous. I think any debt-fueled expansion is always very risky, and that's what Adani is doing right now. As far as the stocks performance is concerned, I'll just give you a hint here. So if you just check out the shareholding pattern of all these group companies, you'll notice some common links there, and that may give you a clue as to what's exactly happening. I think that's what I can tell you right now in public. Yes, I don't have exposure to any Adani Group stocks in my India fund or my personal portfolio. So I'm very conservative investor by nature. And, given what I've observed in the Indian markets over the last 15 years and having seen so many ups and downs, I think conservatism is the best and most prudent strategy to follow in a country like India, in any market for the world, but especially in a country like India. Tata Motors is doing got a remarkable turnaround. Once Mr. Chandrasekhar became the group chairman, I think after that, performance of most of the Tata Group companies has sharply improved, including Tata Motors. Especially, I'm very impressed with the debt reduction across most of the group companies. And like you mentioned, the electric vehicle play, the charging stations, and they're also really improving a lot on the passenger vehicle side. I think they're doing all the right things. So I think longer term they may do well, but I think for investing success, what's important is not how fast an industry is going to grow. What's important is, can you identify consolidated profit pools within the value chain of an individual industry and identify companies having supply side dominance or dominant market share, because competition acts as friction for value creation. I basically want to minimize the competition to the maximum extent possible. I'm looking for monopolies or oligopolies at best within the value chain of an industry. I want fragmented customers and dominant supplier. That is what I'm basically looking for. So if I want to play on the electric vehicle growth in India, I will look for an auto ancillary company which is catering to all the electric vehicle players and having a dominant position in the particular auto component which it supplies. So that is how I would approach investing in any high growth industry, because high growth does not create value. It is return on capital employed over cost of capital, which leads to shareholder value creation. And that can only happen when the company has got a strong competitive advantage. We saw in the dot-com bubble 2000, 2002, and the recent mania as well here in the US over the last 2 years. What happened? Many companies were showing high top line growth, but as soon as the bubble busted, all of those companies have just crashed to the ground, 70-80%. And that's why many people in this country are now realizing that they were just the very beneficiaries of all this cheap money printing and easy liquidity over the last 13 years. But once the fundamentals took over after 13 long years, now again people have started focusing on balance sheet and cash flow. In my view, that should be the focus at all points of time. But problems, people don't look at the balance sheet and cash flow or working capital in a bull market. They only focus on the income statement. And sometimes when the bubble goes to epic proportions, then they focus, instead of income statement profits, they focus on the top item, which is revenue at the top of the income statement. That's it. So basically, as the bull market matures, people keep going more and more up in the income statement, from net income to profit before tax to earnings before interest, tax, and depreciation and EBITDA basically, and then to EBIT, and then to gross profit, and finally at the peak of the cycle you look at market cap to sales. That is when the bubble burst basically, which happened in the US market.
But how is maybe fintech in general? I mean, maybe that's kind of a broader question, right? Because presumably there's got to be a good fintech community also that's building there.
Fintech, frankly, I think it's more of a glorified term, to be honest. That's what I feel, this very term. I think it's just lending business with an app, and people just term it as fintech loosely in many parts of the world. But I think what matters in a fintech or a lending business, first, I just focus on the basics for every business. In a lending business, the good news is front loaded. Getting people to take money from you and showing high loan growth is not a problem. The bad news is backloaded, because the bad loans, the defaults happen later at the very end. So I would rather focus on how the company is managing its lending practices, asset quality, non-performing assets first, and then focus on the tech later. Because there's no point of this. The tech is basically useless if your borrower is not paying you back the money at the end. So I would rather focus on the fundamentals of the business than this tech value add first. I mean, technology is good to have, but I would first and foremost focus on whether you're actually making money from the people to whom you're lending money, and whether you're getting your principal back.
Yeah, no, that makes sense. Okay, and maybe for the last question on my end, and again, everybody, please make sure you follow Gautam on Twitter. I will have this again as a podcast soon enough. What are some of the bigger risks that kind of keep you up at night when you think about investing in India? So obviously, there's the idiosyncratic aspect of the individual companies. There's the global beta, risk, tail risk. But is there something specific to India that makes you nervous from a macro perspective at all?
I think global investors find a lot of comfort with this stable and strong majority government at the center. And if something were to happen to PM Modi overnight, that would be a big tail risk, because currently India also enjoys what is known as a PM Modi premium, because he's led the BJP to 2 consecutive terms in power with a very strong majority. And foreign investors, what I've observed from history is they prefer a very strong majority, stable government at the center, at the helm of affairs in India, rather than a coalition government. So in case you have a big political setback in the country of India, in which the BJP government gets toppled over and a coalition government comes to power from the opposition, That is one risk which may happen. And apart from this one risk which is specific to India, there's also a big global risk on the horizon over the next few years, which may happen. It's a low probability event, but what if you have a situation where China actually invades Taiwan, and basically you have a situation where you have World War III taking place with China, Russia on one side, and the Middle East countries on one side, and the US, EU, and other countries on the other side. So that is a big tail risk for the global equity markets in the next 1 decade. I hope that does not happen. But given the recent actions along the Taiwanese Strait, I think there's a risk which all investors have to be cognizant of. That's the only one big tail risk which just is a bit worrisome. And I hope it does not happen.
Again, everybody, please make sure you follow Gautam. Thank everybody for joining. I do appreciate everybody that joined here. And Gautam will be in touch. I appreciate it.